Good morning. It's 11 a.m. on the West Coast. That's 2 p.m. for those of you on the East Coast and something else somewhere in the middle. To our friends in Hawaii, good morning. Get up, get out of bed. We're back with a really cool webinar. We have a huge audience today. We are a sellout crowd. We even had to bounce a couple to let some extras in, those that said they weren't going to make it. So I hope we accommodated everybody we could. We have a very special guest who we will introduce in a moment. Forgive him for his Baylor thing. It's not his fault. Not everybody can be a Buckeye. It's just not the way the world works. My name is Eric Greenspan. I'm a hockey dad, a soccer coach, and all that other stuff. You want to learn about me, you can go to ericgreenspan.com. I run the Ignite program and schoolofbookkeeping.com, 74 systems, and those are all kind of the same entity. They're all fall under 74 degrees LLC. 74, the significance, that's the average temperature of Santa Barbara. And I've been here 32 years, so I aptly named my company because in marketing, you want something people will remember and something that has a story. So I ask you, this is something we talk about in Ignite. Are you achieving all of your goals? And no, nobody is, but are you working towards it? Now, let me just give you a quick tip. If you set a goal each day and you achieve that goal, you're going to lift yourself and you're going to probably get up and run to your desk the very next day. Work on achieving goals and building new goals and keep setting them higher and higher and higher. When I started at IBM, my boss said to me, I said to him, I said, I want to go into this deal with you. And it was like a $7 million deal at UCSB. He said, nope. I said, why not? He said, because you've never sold anything for $7 million, have you? I said, no. He said, go sell a computer. So I did. He said, go sell 3. So I did. He said, go sell 10. So I did. And then I came back to him. I said, can I go with you on the $7 million deal? And he said, no. The point is, though, is he was trying to teach me to grow, to reach that new plateau. And each time I did, I felt a little bit better about who I was and more confident, and it helped me get to the next level. Do you have enough good clients? This guy here's a client. Mike and I have been working together for quite some time. And I got to tell you something. 2 things I love about Mike, and I'm going to use him as an example. 3 things. He pays on time. That's very important. The second thing is, this is very, very important. He's cool. We get along. But here's the most important one. He's straight with me. If I'm not delivering, or if he has questions, or if he screws up, he's straight, dude, sorry, I dropped the ball, or dude, what are you doing? What's going on? Give me some feedback. That's the kind of thing that makes a relationship work. You can't go quiet. Mike is not ashamed or afraid to pick up the phone and say, where are we at? And then I send him a chart of what I've been working on. He's like, cool. And he goes off and enjoys his weekend, okay? So he holds me accountable, and that's very important, but he always does it in such a professional manner, and I really appreciate working with him. He's a good guy.
Hey, thank you.
Are you making enough money? I'm going to raise your price, by the way, Mike. I didn't want to tell you that privately. I didn't think it was appropriate. You have to make enough money, folks. I don't know if you have hockey kids, but I'm sure you've got kids that need dental work and that have all kinds of other things. It's expensive to raise a family. It's ridiculous. I mean, what does a gallon of milk cost in your town? I know in Hawaii, it's like almost $10 now. It's ridiculous. Everything in Hawaii is a bit inflated. But I mean, it's what, $6, $7, $8 for a gallon of milk, good milk. And here's this question. Why do they make non-organic food? Explain that one to me. Everything should be organic. We shouldn't have the option. But we do, and yet we have to pay through the nose for it. An organic lemon is $2 and the other one's 40 cents. Which one do you buy? Well, you shouldn't even have to think about it. Make money so you can feed yourself properly. You don't have to be extravagant, but eat organic food. That's a great bar to set for yourself. And are you having fun? I made a joke about Baylor because because Mike and I can give each other a hard time, and because he's not a Buckeye and he's sorry for that.
No.
Gotta have fun, and most importantly, I ask you, do you love what you do? Before we get started, make sure you maximize your screen, folks. Get that Zoom window full and big. Get it all, everything's sized properly. Click the buttons, make sure everything's looking good. You should be able to see everything. You should see event primer at the top. You should see our logo at the very bottom, and you should see live weekly recorded at the bottom right. If you can't see all that, you're not seeing the whole thing. Make sure you maximize it. Use Q&A if you have a question, please. If you have a question and you expect an answer, use the Q&A feature. If you just want to have an open discussion and have some fun or whatever it might be, you can use chat, but don't expect an answer for chat. We're not going to look through and filter. It just flows like crazy. So put your question in Q&A as it comes to your mind, and we will address it. We will not have Q&A at the end. We'll just ask you to ask your questions as they come to mind. If you're here for CPE, you must vote in the polls, but we ask that everybody does. We don't know who's answering or who's responding. We just know the responses, and it gives us guidance as to where we're going in our presentation. So we'd really appreciate that. And I'm going to start the first poll right now, which I'm required to do. And this is, are you attending for, it should say CPE credit. I apologize. Okay. So while you guys are answering that, I'm going to move this thing over to here, and we are going to get started. So today's presentation is called The Speed of Cash. It has two parts to it. One of them is that you need this skill for yourself. I need it. We all need it. Cash flow is very important. But it's also an amazing tool for you to be able to use as a service for your clients. Managing cash flow, pretty important stuff. And there he is, Mike Milan. Picture looks a little different. It's okay, my Facebook picture's from 2011 too.
It was just a haircut, it was a bad haircut.
So Mike, we're gonna turn this over to Mike. Mike is, he has an MBA from Baylor. He's VP over at Finagraph, but most importantly, he's a former Missouri State Trooper. He has had his share of opportunities to knock solo cups out of people's hands, we were talking about earlier. And Mike has a new product that I fell in love with, which is why I asked him to come on. It's not, this webinar is not about selling you this product, but I'm pretty sure you guys are gonna wanna use it. But we're gonna use it and its concept to help you understand more about managing cash flow. And I turn it over to you, Mike. You may take the screen. So share your screen.
Yep.
Off you go.
Off I go, great.
As soon as you're up and running, folks, I'm gonna step out for 5 minutes and go be a dad. Mike, you have my cell phone. If something goes awry, I'm sure you'll be perfectly fine. But before I do, can everybody see Mike's screen? Somebody let me know in chat.
Anybody?
Perfect.
Good.
Okay, Mike, I'll be back in 5 minutes. See you then.
You're the best. Hey, thank you, Eric. I appreciate it. And I tell you, I mean, this is always one of the great things I like. I mean, yeah, former state trooper, of course, but more importantly, right? I mean, what I do is I teach cash flow all around the country. I mean, if you're an analyst, we'll say at Wells Fargo, I'm the first guy you see, right? So I think that's where I'm good. I think that's where I like to focus. I'm in the middle of building my 10th company. I've had a hotel staffing company with about 500 employees. And again, it was all about managing cash. And what I came up with is that it's the speed of cash. It's how fast it moves through your company that's important. Because believe it or not, the faster you can make the money move, the less you need to keep the company in operation, right? So, and let me just start off by saying, well, you know, why is this even important? You know, why is it important that we do that? If I can now, oh, there we go. It's important because of who we are in our clients' lives. I mean, if you're an accountant, if you're a small business owner, if you're a banker, it doesn't matter. I mean, who are you in your clients' lives? And I always ask people, I say, what business are you really in? You know, and it's important to know what business you're in because I'm in this business right now. If you go to our website, that's my profile picture on the Finagraph website. Yeah, that's right. That's my granddaughter. And she has no idea that she's on our website, but I just thought that was the most hilarious profile picture I can come up with. So yeah, I'm today's modern grandpa, and I'm exploiting my granddaughter. But no, I think all of us, if you're an accountant, if you're a banker, even if you just have customers in your small business, you're in the dream fulfillment business, especially from the accountant's point of view. The dream fulfillment business means that all of your clients are expecting you to help them and be that trusted advisor for them and help them make money. This is going to be, the next hour, we're going to talk about how to do that, how to watch cash, what are the key metrics, and what are the numbers you need to help your clients, achieve that dream. So your job, if you're an accountant on this call, your job is to help your customers stay in business, right? It's to help them do that. And I know that we use accounting from a historical perspective, but I wanted to go a step further and say, let's start looking forward. Let's start looking at things, not the decisions we made that we already bad decisions. We're seeing the results of it. Let's start taking the action to make us not have those type of bad decisions in the future. So here's the reason why it's important. Based on the SBA, these are the top 10 reasons that businesses fail, right? Lack of experience, poor location, poor inventory management, overinvestment, poor credit arrangements. This is the reason why I'm passionate, is that I have a new mission. When we started Finagraph, my mission became very simple. I want to eliminate cash flow problems as a reason that businesses fail. And if you look at the top 10, 7 of the top 10 that I just bolded are cash flow management problems. Understanding it, knowing how they occur, and knowing the dynamics behind it are going to help you and your clients avoid them in the future. So I want you to help me. I want you to go on this mission with me, and let's make cash flow not the reason businesses fail. We don't want anybody to fail. So it's true that you can be profitable and not be able to pay your bills. All right. Here's a stat. 50,000 businesses per year file bankruptcy. 50,000. Of that 50,000, 35% have net profit on the books. If you look at their income statements, they're making money, they're making sales, they're showing profit at the bottom line. They're still filing bankruptcies. They're still in a position where they can't manage their cash. Another story from 1985, if anybody knows the company Home Depot out there, what you may not know is that they were 21 days from bankruptcy, right? In 1985, they had followed the Walmart model of growth and just started plopping down Home Depots all over the country and ran into a cash problem. They had $9 million to live on with a $12 million cash burn, which gave them 21 days of cash. There was some fancy refinancing and some, creative financing done by the management team in a bank to be able to pull that thing under control. But if it can happen to a giant like Home Depot, it can happen to you and I. So I always try to look about that. So some of the things I want to point out on this slide is, about paying your suppliers, carrying too much inventory, extending credit to the wrong customers. Let's look at it like this. We want to be able to manage the cash from a perspective that keeps it fluid, that keeps money coming in and keeps money going out. And the way we do that is to look at our company as a machine. Yeah, what you do may be different for each person. You could be a great dry cleaner, great in the tire business, great restaurateur, but every business is designed to be a machine, a cash machine. So I want to put that notion in your head. So when we're looking at our businesses, they're designed to be machines, and that machine prints money. Now, because I've got machine in your head, I want you to think about cash and the way it moves through the company as gears, right? And that's what we're going to be controlling, is the speed of those gears. You've got a driving gear, one that's powerful, one that spins fast, one that, creates all the momentum for the company. And then you have a driven gear. So when the gears mesh, the driving gear is propelling the driven gear. The driven gear, you want it to be large and slow and cumbersome. You don't want it to, move without that. Driving gear meaning the money that's coming in, and the driven gear, the money that's going out. And here's where you're going to find those things up on.
You just lost your video, buddy.
Oh, you did?
Mm-hmm.
Oh, great. That always makes me feel happy.
I
hit my computer with my elbow and it changed everything.
I have this thing on my Mac that if I touch it in the wrong place, whatever I just wrote disappears.
Yeah.
Most frustrating thing ever.
Exactly what happened right then.
Go for it.
All right. So Here's some key points that we're going to look at when we go through some sample exercises, and I'm going to show you kind of how to do the math and how to get these numbers that are going to be necessary to run your business. All right, for the driven gear, that high-speed driving gear, we're going to look at how much is on your accounts receivable. We're going to the balance sheet for these numbers. How much you have in inventory. How much do you have in accounts payable, right? Those are all the things that make up the working capital cycle or the cash conversion cycle. For our driven gear, the one that we want to go low speed, we're going to look at operating expenses. So let's start with the driving gear. Let's start with the one that creates all the momentum in the program or in the company itself. And we're talking about, is there a financial gap? I also call that a cash gap. It's important to know because this is the amount of money that you're short to make sure you have a sustainable business, right? And understanding how much that is super important to being able to understand if you have a financing need or if you need to go out and collect more money and bring some in. So, and then what is your working capital position, what that means. So when we're looking at the driving gear, you know, the thing that creates all the momentum, we're going to look at working capital, which is really just current assets minus current liabilities. Some people will call it a cushion. And where you want that cushion to be is really dependent on you. You know, I've got clients that I've worked with, and matter of fact, in my hotel staffing company, if I didn't have $50,000 in the bank, I was sweating it. Mainly because I knew I had payroll coming up every 2 weeks, and that was the bottom line. Zero wasn't the dollar for me. My baseline was 50,000. So when I dropped below that, that's when things started to come into motion where I needed to propel some of the collection activities that I had. So it can be expressed in dollars or a ratio. Here's the thing about ratios. They don't mean anything unless you compare them to something, right? So I like to talk about dollars because we can spend dollars. You can't spend percent, you can't spend ratios, but you can spend, you know, dollars. So I like to think about working capital in the form of dollars. So what is the financial gap? What am I talking about there? This is the calculation that banks use to determine how much you need on your line of credit. I don't know if you've done this or not, but I've seen it 100 times where a business owner goes into a bank and asks for a loan. They say, hey, I need a loan, Mr. Banker. And the banker's first question is always, what do you think it is, Eric?
Do you have any collateral?
Yeah, that comes next. But they always say, well, how much you need?
Oh,
right?
As much as you'll give me.
Yeah, and that's the answer, right? The answer is
how much you give me. Yeah.
How much you give me. That's not the right answer, right? You need to be prepared to have that conversation with the bank. And by knowing these numbers, it will tell you how much to ask for.
So I actually could answer that question better for you in a real life scenario.
Yeah, good.
We're in a company, my only company that ever failed, that was successful for 11 years. We went in and asked for more capital to our investors, and they asked us how much we needed. And we knew we needed 150,000 to cover the shortfall. So of course we asked for 300.
There you go. And you got how much? 300?
We got 350, I think, at the end of the day. And it still wasn't enough.
Still wasn't enough. Okay. Well, let's talk about this. This is the calculation that you use to be able to determine that financial gap or that cash gap, right? And the cash gap is designed to be covered by either a line of credit or cash that you have actually access to, or you need to do an equity raise and get your partners to throw in more money. So it's three numbers are used to determine this cash gap, and it's the inventory days, AR days, and AP days. And I'm using the word days, right? Because I talk about speed, and we measure speed in businesses by days. Now, can't do miles per hour like when I was a trooper, but you can measure it by days, right? So that's why we convert turnover ratios to days, because we can measure the speed. How fast does money move? So when you take inventory plus AR minus AP, that equals your financial gap days. Those days are then covered by your cost of goods sold in an inventory type of business or something that you carry inventory. Inventory comes off of the balance sheet. When you sell it, it's no longer an asset. It's actually an expense or your cost of goods sold. So you take your cost of goods sold, divide that by 365 days for last year, and it gives you an average cost of goods sold per day. You take the average cost of goods sold per day and multiply it by your financial gap days. That's the amount of money you need to run your business. And I'll show you how it works.
It's a good thing we're recording this, because I'm going to have to watch that part over. Hey, Mike, before you go on, I have a very important question.
Sure.
How many miles over the speed limit do you really let people go?
Okay. Personally, you know what? That's the number one question I always get that.
9 miles over the speed limit acceptable. That's my rule of thumb. 9 miles over.
I drive 9 miles over. Now, what I tell people is you can drive as fast as you can afford.
So I look at it this way, okay? I simplify everything down to one thing. What's 9 miles per hour over the typical speed limit?
79.
74.
Oh, 74.
It all comes back to that. Go ahead.
California's got 65, but you can only go 20 there.
No, you go 5.
5. Got it. That's how Seattle is as well. I mean, 5 or 0. That's about the average speed. Okay, so here's a diagram that helps explain how this works. When we talk about the speed of cash, we're talking about how long does it take for a dollar to come back to you, right? If I take $1 out of my pocket, buy some inventory, that piece of inventory is going to sit on the shelf for a certain amount of days. Then somebody buys it. Let's assume that I sold it on credit. And because I sold it on credit and I gave them an invoice, it sits on their desk for a certain amount of days. That's the AR days, right? The aging of that invoice as it sits there. The combination of those two, how long it sat on the shelf and then how long the bill sat on the customer's desk combined together is the speed that it takes $1 to return to you. How many days is that? Now, what's interesting is that while you're waiting for money to come back, you also owe your own bills. You have a vendor that you bought the inventory from. So that bill comes in, it sits on your desk. So when you subtract that amount of time that it sat on your desk from the amount of time it takes you to receive the money, that's how you calculate the gap. So if you look at it here, it's inventory days plus AR days minus AP days equals the financial gap. Now, some of you might be out there saying, oh, Mike, I'm in a service business. This doesn't pertain to me. That's not going to work. No, it's totally different. Remember, I run a hotel staffing company, and the thing you use there is your amount of payroll, right? My average collection time in my hotel staffing company was 45 days. I paid every 2 weeks. So during that 45 days, I had 3 payrolls to cover. So I had to have enough money for 3 payrolls. That was my gap. So I always had to have, and that's where the $50,000 come in, enough for 3 payrolls. And as long as I kept that, I felt safe. I could at least make a payroll. So it makes sense?
It does. But I think a lot of people on this, certainly if they're clients of ours, and you know this well, are getting paid in advance. So if you're getting paid in advance, do you have a formula for that? Or should we talk through that? Or should we do a part 2?
We can do a part 2 on that one. We can do a part 2 on that.
I would love to thrash that idea around with you, sir.
Yeah, because the paid in advance creates another. Yeah, go ahead.
It's a scary thing because you have the cash, but then you have to decide where to spend it.
That's right.
And if you I'm going to pay off this credit card.
Yep.
Then all of a sudden you need it and it's gone, but you've got an available credit card, but you can't pay employees with Visa.
Yep. Okay, the second half of this, what you're going to do here, I've been telling everybody on the call that the most important piece is the driving gear. That's what we're talking about right now, driving money coming in.
Yep.
That's the opposite problem. This is controlling, what you're describing is controlling the driven gear or money going out, right? And we'll do that with days cash on hand, right? And that's, and I've got that already listed. So once I go through this and kind of help somebody, help them understand how to calculate the financing gap, then we'll go into the driven gear and talk about days cash on hand and how to evaluate whether or not you have enough.
Got it.
Got it.
Great presentation, man.
Yeah, let's talk about, the 3 components, right? You got inventory days, AR days, accounts payable days, right? It's how long does the inventory sit on the shelf? How long does it take me to get paid? And how soon do I pay? And if you want to, do the math, for people that swim in the deep end of the swimming pool, the math pool, there it is. Ending inventory, cost of goods sold, accounts receivable, net sales, accounts payable, cost of goods sold. Those are the components. That's how you do the math. Believe it or not, there are computer programs out there that do this for you. So, but if those people that still like to do it, that's fine too. So let's talk about a sample problem, right? Things that I pointed out, for working capital was, your current assets, your current liabilities, you've got your inventories. What I've done is I went to that sample balance sheet that I had on the first slide. So if this is a recording, you can go back to that, kind of take a screenshot, or if Eric, you want to make the slideshow available, that's fine too.
I'm actually going to make this recording available to the public free.
Okay, great. Hey, all right. So they'll have all of this information. Just know that I took these numbers off of that income statement. I took them off of the balance sheet that I showed you in one of the initial slides. So that's where the numbers are coming from. So when you see it on the next slide, I don't want you to say, where do you come up with this number? I can come back and I can show you where it came from. So here's the working capital calculation, right? I took the 2 million minus the 1.5 million, and we've got $530,000, right? That's how much the cushion is. Is that enough? That's what you have to ask yourself. And the way you ask yourself is, I have 530,000. Does that cover my financial gap? If it doesn't, you have a financing gap that you need additional money for. You got current assets. The ratio works like this. Instead of subtracting it, you divide it, and it comes up to 1.35. People say, oh, I got a 1.35. What do I do with that? You know, nobody really knows. Here's how you evaluate a ratio like this one, the working capital ratio or current ratio. I like to use a sample of a current asset and a sample of a current liability to help business owners understand what this means. The sample I use for the current asset is just your checking account. The sample I use for a current liability is just a credit card. And I'll tell them, for a 1.35 current ratio, I say for every dollar you owe on a credit card, you got $1.35 in the checking account to pay for it. That's simplification because it takes all the current assets and all the current liabilities, but it helps them understand that I have $1.35. Now, is that good, fair, or terrible? In my way of thinking, it's at least fair, right? You'd have to compare it to the industry average to know if you're better than average or worse. But here you're saying, hey, at least for every dollar I owe, I got $1.35 to pay for it. So that's kind of how you read a current ratio. And that's basically what I'm saying in the bottom part is I've got $1.35 to pay for it. And because it's a positive number, it's positive working capital. Here's the three stages of working capital: positive, neutral, and negative. Believe it or not, you can have negative working capital and it works, you know, and it's usually the high growth companies. Negative working capital, though, is where the auto industry got into trouble and needed bailed out. I don't know if you remember that or not, Eric. I mean, it's a big deal. The government
I remember it very, very well. In fact, it was Chrysler who took the most, right?
That's right. That's right. And what happens there is that, you know, that they tried to run a negative working capital. That means they were leveraged pretty high. They had high liabilities, low assets. And again, it's negative working capital, and it usually looks like you're struggling, right? So if you see negative working capital, the typical thing is it's bad. But some high growth companies, maybe like Finagraph, can operate with a negative working capital because of the growth.
Or like Amazon did for such a long time before they turned a profit. But they had to fund it somehow, and they did. And I think Bezos did most of that with debt, though, right? Before he went public.
That's right. Yeah, he built it on debt and then went public, and of course, you know, they still carry a lot of debt.
Yeah.
Back. So neutral working capital is just that. You usually see that in a just-in-time inventory, where, you know, as the money's coming in, I'm paying it out for the inventory. That's usually what you see, is somebody trying to be just in time.
I would imagine that's probably the majority of our client situation, the ones that at least are new, you know, when they're getting started in the industry, because they're not confident enough to raise their price up to a level where they're not able to sell, you know, because the higher the price, the harder to close the deal. Yep. So they're underselling themselves, and they're basically bringing in $1 and putting out $1.
You know what? That's exactly right. As it's coming in, it's going out the door. But that's not bad, right? It's still
bad if you have a couple of days where you don't have anything coming in and it's still going out.
That's true. That would put you in a negative. That would put you in a negative. All right. So,
by the way, Mike, I just have to tell you a funny thing. I'm actually, while we're doing this, negotiating with a lender.
Are you really?
For working capital, because we're expanding. We just hired Mike. We want to grow the business.
Right.
So I've decided to do some debt consolidation and get some working capital to expand the company. And so I've been working with a number of lenders, and he just texted me saying we're there, we're done, and we'll have your paperwork for you shortly.
Hey. Well, then this webinar is about 2 weeks.
It couldn't have happened on a better day.
Got it. Yeah. Okay. Good. Okay. So now we're going to calculate the financial gap and how much money it takes to finance it, right? So in this case, all of these numbers again came off that sample page, and when we calculate the AR days, AP days, inventory days, we've got 90 AR or inventory days. We've got 34 AR days and 56 AP days. So when I add 90 plus 34, I get 124 minus 56 equals 68. So that's where we're coming up at. That means I need enough money to cover 68 days worth of inventory in a retail type company, right? It's sitting there for 90 days. I'm getting paid. And you got to think about it this way. You want that gap to be small. You want to have to carry a lot, just a little bit of money, not a lot. So the gap has to be small. In this case, I want to show you the levers that you have as a manager to pull, right? This is what you do. You've got the inventory days as 90. You've got AR days as 34. Those are two levers. I can speed up or reduce the amount of inventory that's on my shelf. So I'd want to reduce that. I've got AR, 34 days is not that bad. I might not be able to do that, right? That's a double-edged sword with AR. If you collect too fast, it could actually hurt your sales. So, I mean, I like to hover near the industry average on AR, but in this case, 34 is not that bad. So I probably can't manipulate that and reduce it. But again, if you can collect faster, this also reduces the financial gap. So you want these two things to be smaller, right? That actually puts more cash into your pocket and less cash on the balance sheet. Then, of course, we're going to subtract AP days. This one's just the opposite, right? But again, if you stretch your payables out too far, you could hurt your relationships. You could lose vendor relationships. You could be missing out on discounts. But in order to make that gap smaller, I can push the AP that way or move the AR and the or the inventory that way. But your financial gap is the difference between the two. So reducing inventory, reducing AR, and increasing payables is a way to reduce that financial gap. In this case, I think I only have one real lever to pull. You know, which one, Eric?
Sorry, I had to mute.
Oh, that's right.
I'm guessing that you're going to go after getting the money.
Well, actually not. I mean, in this case with this company, if I was a consultant, I'd say, hey, listen, we're doing okay with AR at 34. I think we're carrying too much inventory, you know. If
definitely. Okay, I see.
Yeah.
So because you said your business was 45 days. Is that typical? Is 45 days an average that people live with in traditional business?
Yeah, if you look at it, and there's RMA data or there's industry averages, and every industry is a little bit differently. I mean, like some of your clients, or some of your I guess their clients on this call collect in advance, right? So the AR is going to be minimal or nothing, right? So it just depends on the industry and how your business model is set up.
And you know what's funny about that is for the clients that don't, a lot of our clients get some paid in advance, some are paid in arrears, some are half now, half later. Yep. They spend more time chasing money and spending money to chase money. Mm-hmm. For the smaller amount of people that do that. It's extraordinary how much time is sucked in there. There's other factors that play into this. So by reducing your AR days systematically, mm-hmm. right? There's one thing we could probably add in here.
Okay, go ahead.
74 systems. I'm not pitching, but I'm serious. Automation, right? You can build processes in here, and you and I are gonna work on something. I have an idea. But if we were to take this same thing and apply it to bookkeeping and tax practices, and we were add some technology and efficiencies and things of that nature to improve AR and to reduce AP. I don't know about AP. I mean, certainly paying people through Zelle same day is going to help your relationships, right?
Right. But it may impact your cash.
See, that's the problem.
Yeah.
That's the problem with Zelle. It's okay if you pay them today. Just don't take the money out of my account yet.
That's right. Hey, we had a question about translating this to a service business. And yeah, I gave you an example earlier that I wanted or that I had just for my service business. But let's see if I can put it to you this way. In a timeline, a service business, I would translate this way. In a timeline, we'll say January, February, March. Right.
And remember, folks, as he's doing this is to apply to your business. But what the reason for this webinar and why Mike is talking about this is because we want you to be able to use this as a service to your clients. And there are probably plenty of them that do carry inventory. I know that for a fact because of the products you use. So that's why this was designed for both you and for you to be able to use as a new service in your trusted advisor capacity.
Absolutely. Here's what I would do. All right. We don't have inventory in a service business, so that number is 0. But you still got AR, right? You're still looking for money coming in. If you're not a cash-based business and you're invoicing your clients, you're still waiting for them to pay. The key number on a service business is this one. How long does it take you to get the money? Because your largest expense in a service business is your payroll. So instead of AP, you have payroll. So what I want to do there is say, if I'm paying every 2 weeks, I've got 34 days to cover, right? I have to wait 34 days to get money, and I pay every 2 weeks. How many payrolls would I have to cover, right? So it's 2 weeks, and 2 weeks is really 30 days. You could say just a little over 2, right? So I got 1 pay cycle. So this is 2 weeks is 1 pay cycle, 2 pay cycles, 3 pay cycles.
These pay cycles can be your draw too, if you're a single person service business. So that's, you have to pay yourself. You have to pay your own overhead. Of course, you would never pay your utilities out of your business checking account. That's just never done.
Sure. So yeah, so what we're doing is we're covering it. So if I'm paying every 2 weeks and my typical amount, we'll say, is $10,000, and I need to cover 3 of those, then it's $30,000 and I'm going to need to cover.
And you know what the inventory could also be too is their time.
Could be time. Yeah. I mean, your inventory is actually the amount of hours that are available to work.
That's right. Yeah. How much production time you have.
That's right.
I can only get about 16 hours out of myself each day.
Yeah. And that turned out really messy because I'm afraid to touch the computer too hard because it knocked the video off last time. So
I'm impressed you can do that. Do you have like a Wacom tablet, or what are you using?
No, it's just a Surface, right? It's just a Surface.
Oh, right.
Yeah. And normally I kind of lean into it and write on it like a regular pad, but again, last time I touched this thing too hard, it created a problem. So, and there's probably some stuff coming in chat. I haven't been monitoring chat, but
folks, remember to use Q&A, not chat, for questions that come in. We don't monitor chat. We're going to have to pick up the pace though, because we only have until 11:50. How many? We good?
Got it. Yeah. Okay.
I mean, we can go a little bit long, but we want to make sure everybody gets to the end.
But we're actually just about done, buddy. We're almost done. So this is the driven gear, right? So that's really the driving gear where the money's coming in. Now we're talking about the driven gear, money going out. Normal people talk about, days cash on hand. I like to call this days to bankruptcy, right? It creates a surge, a sense of urgency. How much cash do I have on hand? Now, Eric, this is also where you're talking about, hey, I have the cash. What should I spend? What's good enough? What's not good enough? The way we calculate days cash on hand is the amount of money that you have available. And that's not counting anything that's restricted. Some people have restricted cash accounts. Maybe there's an attorney out there that has escrow money. It's not theirs, right? So we want to include that. So when you look at his current assets, you might have current assets in the bank for escrow, but it's not his money. So if you got restricted cash, make sure you're not including that in this calculation. Again, you got operating expenses minus your non-cash. That's all your depreciation stuff coming out of there. Again, divided by 365. And that's how we're going to calculate how many days worth of money do you actually have. Here's how to know if it's good enough, right? The calculation is down here. I had 85,000 in the bank. I took my operating expenses of 2 million, subtracted out my depreciation, divided by 365. It gave me 17 days of cash. Is that good or bad? Right? So, and what I've done is built this little chart for you. Less than 0, it's bad. 45 days or more is kind of the target, right? That's what we're looking at. It kind of tells you about where you fall. In this case, this company has a little bit of a cushion, but this month they could also collapse, right? If sales stopped, hurricane took over, that's really what we're talking about is, do you have a war chest? Now, a typical company, I always advise them to have at least 3 months worth of operating expenses on hand. That's just typical. Now, 45 days or more is good. I like to say 90, right? That's just the safety in me. Now, if you hear the term war chest, here's what that means. That's where you have enough cash on hand to take advantage of opportunities or to ward off threats. Again, like the hurricane in Houston, they say on average it takes 30 months to recover from a natural disaster.
We're going through that here. We lost a month and a half of revenue
with the mudslides.
Because of the mud, yeah.
Yeah. They say it's a 30-month recovery cycle. Well, what most people will do is they'll have 18 to 24 months operating expenses on hand, and that's called a war chest, right? And that's how companies like Facebook can say, I'm going to go buy Instagram for $1 billion, is because they've developed that war chest.
That's not a war chest. That's one of those like caves with coins and jewels that you see in
that's right. That's
Aladdin, the Disney movie, you know. And those companies have so much money, it's not even funny. All right, Mike, real quick, we did have somebody who accidentally used chat, and we're not going to punish them for doing that.
Okay.
We're going to try to answer. It says, okay, so we did service companies. You know, hold on a quick sec here. I'm going to lower all your hands first. I want you all to find your electronic hand button, and I want you to raise your electronic hand if you think it would be interesting for Mike to do a part 2 directly focused at your specific industry for service business for you. This one was for you to be able to use for your client. Hands are flying up in the air.
Okay.
So I'm guessing they really appreciated this because they're looking at it for their own business, but now they're saying, okay, this is cool, but I'd like to apply it to my business as well.
Yeah.
You got some, holy mackerel. I've never seen that many hands. Thank you guys. Okay. I'm going to speak for Mike. We'll do it.
All right. Hey, yeah, we'll do it. We'll put it together. Hey, you know, again, I can't fulfill my mission of eliminating cash flow as a problem, and unless I get out there and evangelize. So yeah, let's do it together.
We're definitely we're going to do a part 2. As long as we don't run out of cash flow, we'll see you soon.
There you go. So here's kind of the closer on the driven gear, right? It's, you want to be able to control your speed. That means the driving gear, your working capital, you want it to be a small amount of days. Think about a small gear that turns real fast, high speed. A small gear, fewer amount of days. So when you're counting your gap days, you want that to be a small number. When you're counting your days cash on hand, you want it to be a big gear when it turns slow, right? It's low speed gear. So high speed for the driving gear, low speed for the driven gear. That helps you control your speed. So here's how you use it. You're going to help them to, help your clients stay in business by solving their cash flow problems, and asking the question, is he driving the company? Is he the driving gear with his sales, or is he being driven, right, by his operating expenses? And you want to reverse that, right? You want the driving gear to do the work. So Eric, the way they can use this, right? This is my one sales pitch, and then we'll go. If you haven't got it, if you haven't tried it, we have, Finagraph's new tool, cashflowtool.com. You can go right to cashflowtool.com/wow, and you get special pricing just by being, Eric's, preferred client. And what you're going to use here is the numbers I just described to you, how to manage your business. More importantly, we have what's called a cash flow calendar. It predicts the future. We're going 60 days out.
Literally works. I wrote a blog post about it. I'm not kidding you guys. This thing literally told me we were going to have a cash flow shortage. And if we didn't identify it, we would have been in big trouble. And it literally, it was like the weirdest thing. I told Mike about this. This tool's cool.
It made me tear up, man.
This tool is cool, man. So when I first met you, you told me about it, and it was called something else we won't mention. And you said to me, it's kind of like a Facebook for cash flow. And I was like, what?
Yeah,
and then I got in there, and I'm starting to think, oh no, it's going to be like Mint, or it's going to be like this thing is just straightforward. Log in through QuickBooks, analyzes your books, and tells you whether or not you need to go out and collect. So today, do you build your business, or do you collect on your ARs, or do you sell a new client, or do you make the decision to give a discount to close that client on the fence? It's killer.
Well, and I appreciate it, really do. And I'll tell you what, it works. It works on this device. You and your team, your clients, you don't have to be in front of the desktop. It's going to send you a push notification saying, hey, did you see this? Something dumb just happened in your company to take cash away from you. Go take action, right? So that's what we're trying to do. The cash flow calendar is unlike any other predictor. It's patent pending because it doesn't take the invoice date, where if I have net 30 terms, I give an invoice on the 1st, I should get paid on the 31st. No, we know clients don't pay like that. They'll pay, some people pay in 22 days, some people pay in 54. It analyzes the individual payment behavior of everybody, including you, right? And is able to predict, we can almost tell you that you sit down on the second Tuesday of every month and write checks. It's
okay, so somebody's asking if we could show how it works. We're not going to do that in the webinar, but as soon as we finish the webinar, If Mike's willing to stay on an extra 10 minutes, I'm willing to, and we can do a demo off. We'll do it as a second part of it, but I don't want it to be in the middle of it. Does that work for you?
Yeah, I can stay on for a bit.
Okay.
Yeah.
All right. Are you done on this?
I think I'm back to you, buddy. I think I'm back to you.
Okay, because I got to finish up the poll questions for them. And that was Mike Milan, former Missouri State Trooper, who does believe that it is safe to go 9 miles over the speed limit or 74 degrees. All right, so our next poll question is coming up right now. This poll is giving me a nightmare. Poll number 2. You have to answer them here in order to get CPE. So do you track your own cash flow on a daily basis? What is it? Can you do custom financial? Here's a question. Can you do custom financial calendars rather than a calendar year?
In the version 2 that will be out this summer, yes.
Good answer. 2.1 beta.
There you go.
Specific.
It's gonna. It's It's the next version. It's going to expand it out. It won't just be the small feature on the side. It'll be a full screen Outlook. Outlook look and feel where you can drag and drop. I'm going to pay this bill on this day and help you actually pick and select the best times to do things like pay.
Can I pay my bills inside of this tool yet?
Not yet. No, I mean, we're talking with some other integrations. That's kind of later on in the year when we do third-party integrations.
That'd be pretty cool. All right, I'm going to end this poll. Everybody voted. We got one more. CP, you got to vote. 3, 2, 1. Okay, and our third one, we'll have one more after this, and then you guys can run, but we will chat afterwards. Okay, and then this one is, have you ever been in a cash flow crunch? This was my question. I was just curious. I wanted to see okay, I figured. I mean, who hasn't? It's blowing up the top. Everybody's been in a cash flow crunch, except for, I think, probably, I don't know, even my sister. I don't know, I'll tell you. You guys keep answering that. While you're doing it, real quick, we've got a new thing for you, the Ignite program trial. You can choose any one of the Ignite program options. There's a coupon on the page when you go to the Ignite trial. It'll give you half price for month 1. You will not have to commit to ongoing recurring subscription. It's 1 month, half price, any level, and you get everything in it. No, you can't have it, Mike. And if you're interested, now is the time. Go check it out at 74systems.com. And you can choose, we now have tax, bookkeeping, and legal. Bookkeeping prices are a little bit lower than the tax and the legal profession. So make sure you choose the right tab and choose from enterprise to light, any one of them. And you get all of this plus whatever is in its column. And you'll see that when you get there. Okay, and the final poll question. And I'm very, very curious if you guys, I have a feeling you are going to like the answer here. Do you think, I mean, is cashflowtool.com, from what you've described, is it seem useful? I have to tell you, Mike, I was very skeptical. And now I had a preview before it was ready for prime time, and most of it was running on PowerPoint slides. But man, you guys did a really, really good job with it. So answer those. Up next, I finally have this ready for you. We've been working hard on it. You guys are going to dig it. This is value pricing with protection is basically what it is, to make sure you can compare your value price to a percentage of revenue to the line item prep. You'll know actually charging the right price based on 3 different criteria. And then after that, we've got Nellie Akalb from CorpNet, who's coming on. This one's also public and free, and she's going to talk about all this stuff. And I'm actually very interested in the compliance part of it, because we now have another C Corp. It's a nonprofit, and there's so many issues with it. Oh, yeah. That was The Speed of Cash. Our guest, Mike Mylan. I cannot thank you enough. That was fantastic. We will publish this, put it up. You will have to sign up for at least a free membership, but you will be able to access this thing recorded. We cut it there. Any last words, sir?
You know what? I always like hanging out with you. I'll tell you what, I need to come down there.
No, I'm not putting my watch up for a round of pool again. I almost lost it that day. And if I remember correctly, you weren't feeling so hot the next day in front of the bank.
I had a rough day the next day. So you're a hard friend to hang out with.
All right, everyone. I'm going to say goodbye, Mike.
All right. Thanks, guys. I appreciate it.